Okay, good morning, everyone. Thank you for being here this morning on Wednesday. Nice morning, better than yesterday with the weather. So I'm Sofia Bahana. I'm a project manager of the Minority Business Development Agency Business Center. Just to kind of like give a brief overview of the MBDA, we support minority-owned businesses with access to contracts, access to capital, access to markets, and one-on-one consulting, technical consulting for businesses. So if we are here for you, you can reach out to me, and we of course kind of like organize this type of webinars and kind of like a lot of areas, accounting, like law, like right now, and digital marketing. So if you're interested, just reach out to me if you need support. I will go ahead and introduce Fran. We have the privileges to have her here and collaborate with us. She is Fran. Please introduce yourself and let's see.
Okay, sounds good. I'm not sure if you guys can see the slide. It looks like it went away. Can you see that?
No.
I'm not sure what happened there. Okay.
You need to go back a slide.
Yeah.
Okay. It's really weird. Okay. Sorry, everyone. But my name is Fran Fernandez. I serve as director of the Small Business Development Center at C&M. And I just want to take a couple minutes to just tell you a little bit about the services that we provide at Small Business Development Center and how we work with business owners in the community. The New Mexico Small Business Development Center program was founded in 1989, and we've been serving small business owners across the state for 34 years now. We have 18 small business development centers across New Mexico, and our highly skilled staff is comprised of 63 business professionals that have business management experience and business ownership expertise. Our program is funded in part by the Small Business Administration and the New Mexico State Legislature, and we operate through a cooperative agreement with Santa Fe Community College to provide services to small business owners in our community. My center's host institution is Central New Mexico Community College, C&M, and we serve our clients located in our service area, which includes Bernalillo and Sandoval counties. Our mission is to develop skilled entrepreneurs and strong businesses in our state. The Small Business Development Center at C&M provides counseling and training services to help our small business owners start their businesses, to grow their businesses, and most importantly, to stay in business. Some of our client services include our no-cost confidential business counseling to help clients at all stages of business development. We provide technical startup assistance to help our clients understand the steps to starting a small business in the state. And we work with existing businesses to help continue to help them grow and to thrive. We provide business and marketing plan assistance from getting started to reviewing completed plans. We can review available funding options, and we can talk to you about, how to help you assess which is the best options for our clients. We also help our clients access market and industry research as part of the planning process. We have several tools available that we can help with as well. We also offer bilingual counseling and support services for our Spanish-speaking business owners in our community. And to help our clients become skilled entrepreneurs, we offer low to no cost business education workshops and trainings through our online training portal. There are so many advantages to working with the Small Business Development Center at C&M and our community partner, the Minority Business Development Agency, as we all want to help you and your business succeed. So I encourage you all, you can look us up on our website. That's www.nmsbdc.org to learn more about our program. And you can also online, you can register for counseling and training services there. We're always available to help you with your business needs. And today we have such a great treat. Today we have Ian Alden, and he's with Law for Small Business, and he's going to be presenting our Taxes 101 for small business owners. So Ian, I'm going to have you take it away.
Thank you, Fran. And I would just like to add, I've personally done a good amount of work with the SBDC over the years. They're always a joy to work with. So I definitely encourage you all to make use of those resources. A lot of them are no cost to you, and they're really great in whatever life cycle your business happens to be in.
Thank you.
So let me go ahead and share my screen really quickly now. Can you all see the slides?
Yes, we can.
So my name is Ian Alden. I'm an attorney here with Law for Small Business. I'm a tax attorney. Most of my practice is in advising small and mid-sized business owners on everything from startups through, growth stages, sales, acquisitions, mergers, you name it. I mean, it's like I said, every stage of the business life cycle I work with people on. And so what I'm going to walk you through and try and cover today are some of the tax considerations as a business owner, things that you need to be aware of that are your obligation. Because one of the biggest questions that I get is, what do I have to do for taxes? And it's such a simple question with such a complicated answer. We're going to try and cover a lot of that today. If not, my goal isn't to make you all tax experts today. You don't want to be tax experts. I can't make you tax experts in an hour. What I want to do is impress on you that there's different kinds of taxes that you as the business owner have to reckon with, and kind of point you towards some resources that might help you do that effectively. Now, before I get started, I do need to point out that this presentation is not legal advice. Yeah, I mean, it's just not, I can't really know your unique situation as a presenter. And so it's not legal advice per se, it's really just trying to give you some helpful tips and a bit of, education on different taxes. It doesn't create an attorney-client relationship. It just doesn't as a presentation. This is just a one-way communication. So if you're looking to retain an attorney, if you're looking to get some legal advice for your situation, please reach out to us or to any other licensed attorney. This isn't really a sales pitch for me or my firm. I just want to make sure that if you need help, you look for the appropriate help. So we're going to be covering a couple different kinds of taxes today. We're going to be covering income taxes, which is what everyone thinks of when they think taxes. When someone says to me, I'm having problems with my taxes, the go-to is usually income taxes, but there are several other kinds. We're also going to cover Social Security and Medicare taxes, which often get lumped together with income taxes in people's minds, but they're not the same. They're treated very differently in a lot of ways. We're going to talk about payroll taxes, how you deal with withholding from paycheck and paying that off the IRS. We're going to cover gross receipts taxes, which is in some ways the worst tax for New Mexico business owners to wrap their heads around. And other taxes, there's a couple different types of, I like to call them miscellaneous taxes, because they either rarely come up or they're just kind of a blip on the radar for most business owners. If you do have questions, please ask them in the Q&A section. I'm going to try and get through the presentation, and then I've got a Q&A session built into the end. So if you have a question, please feel free to ask it in the Q&A as it comes up. We'll just go through the list at the end. So the first tax we're going to talk about is income tax. And when people think about income tax and their business, a lot of times I get a question, I get people asking, well, how do I deal with the corporate income tax? And I'm going to preface all of this by saying there's an extremely good chance that the corporate income tax does not apply to you or your business. The corporate income tax applies specifically to C corporations and LLCs taxed as them. It is a separate tax on the business for its net business income, which I'm going to throw that term around a lot this presentation. Net business income really just means your gross revenue. I apologize for the typo there. Gross revenue less deductible expenses. So for your net business income, think all the money you're bringing out through the door, less anything that the IRS lets you net out from it, ordinary necessary business expenses, salary, depreciation, things like that. You pay tax on your net business income. Corporate income tax, it's a flat federal rate of 21%. In the state of New Mexico, we have the state corporate income tax that ranges up to 5.9%. I will make the slide deck available. I expect it'll get sent out. So So corporate income tax, the company pays the tax on its net business income, and then the company holds on to that money. It doesn't belong to the shareholders or owners of the company unless the company pays it out in the form of dividends, at which point it's taxed to the owners again at rates up to 20%. That's corporate income tax in a nutshell. It's a separate tax on the business for its income. Like I said, it doesn't apply for the vast majority of businesses. For those businesses, we deal with personal income tax. Most businesses, including sole proprietorships, partnerships, S corps, and most LLCs taxed as disregarded entities, partnerships, or S corps are what's called pass-through entities. You've probably heard that term thrown around before, but what it means is you calculate the company or the business's net business income, same as before, but then that net business income passes through to the owners and is taxed to the owners at their personal income tax rates. So there's no dividends, there's no two layers of taxation like you have the C corps. It's one single layer of taxation. The profits of the company are taxed directly to the owners. And so whereas corporate income tax, you've got the 21% corporate tax rate, and then you've got dividend tax of 20% on the dividends paid to the owners. This is just a single layer of taxes that's taxed to the owners at their personal rates, which is up to 37% federally plus whatever state. And again, I would strongly recommend using the Q&A feature, not the chat feature, because I keep getting notices when you use the chat feature to ask questions. So please do use the Q&A feature. So with pass-through income taxes, let's say you've got a business with 4 owners. They own it evenly, so 25% each. Each owner is going to pay tax on their own 25% of the business's net business income. So if the business makes $100,000 in net business income, or profit, as some people kind of simplify it to, if the business has $100,000 net business income in a year, and it's got those 4 owners, they each own 25% of the business, those 4 owners are each going to be taxed on their respective 25% of the net business income, even if the business never pays it to them. This is a big sticking point for a lot of business owners, is that they say, well, the company never paid me anything. The company made $100,000 in profit, but it never paid me anything. Why do I have to pay tax on it? That's the way pass-through taxation works. Even if the business keeps that money in its own bank account and never pays it out to the owners, you're taxed each year on your respective share of the business's profits. And that is why, and I've got a helpful hint here, a lot of companies, especially partnerships, LLCs with multiple members, they have these things built into their partnership agreements, operating agreements, you name it, called minimum tax distributions, which says the company is going to figure out what the owners are likely to have to pay in taxes each year. You might just round up to 40%, for example, and the company must distribute 40% of the net business income to the owners each year to cover their tax burden. That way, even if you're not seeing a lot of money from the company, you're getting enough to pay your share of taxes on the company's profits. That is something that I always advise my clients to do when they're getting into these partnership or multi-member LLC situations, is make sure that you've got some mechanism in place to get enough money out of the company to cover your taxes. So income taxes, big question, how do I do it? And the answer really depends on the kind of business that you have, right? Because and I'm not going to go too deep into the different kinds of businesses. I know Larry Donahue covered that in his presentation a couple of weeks ago. But, if you've got something like a sole proprietorship, which is just, there's no business entity, you personally are out there doing business under some trade name. If you've got a sole proprietorship, or if you've got an LLC taxed as a disregarded entity, which is for tax purposes the same thing, you can have your single member, one owner LLC taxed as the same as a sole proprietorship. If that's how you're taxed, You just report everything, the profits and losses on your personal tax return, your Form 1040 Schedule C. If you've got a partnership or an LLC taxes one, you're doing a Form 1065, you got to issue K1s out to the owners. If you've got an S Corp, it's the 1120S, C Corp, it's the 1120. And there are different tax deadlines here, which I've outlined here in the slide deck. Typically, if your business has to file a separate tax return, you have to do it by March 15th, with the exception being C Corps. But if you've got a sole proprietorship or an LLC that's disregarded, you just do it on your personal tax return, which is due, I say April 15th-ish, because it really does vary by year. This year it's April 18th. So just keep in mind of these deadlines, because these deadlines, they surprise some people, especially the March 15th deadlines. I get a lot of people coming out around April 10th saying, I haven't prepared my taxes, I'm running up against the deadline, I'm freaking out. And I say, don't worry, you already missed the deadline. So be aware of that for your business tax returns. The other half of all of this, I mean, in my head, I always tie Social Security and Medicare tax in with income tax, because it's collected in similar ways, usually on the same base of income. And it comes in two flavors, depending on whether your income is from employment, like wages or salary, or from what's called self-employment income, which is pass-through profits. So pass-through profits from your LLC, your partnership, your S corporation, any of those pass-through entities, the profits that you get that aren't salary, they're called self-employment income. And so we're going to talk about how Social Security and Medicare tax gets collected from both wages, because this matters for your employees and for you if you're employed by your company. And we're going to talk about how it's collected from everything else. Like I said, the profits of the business, the net business income, you typically still need to pay Social Security and Medicare tax on that, unless you have an S Corp, which we'll cover briefly. So some of this you probably already know. If you have employees, you're required to withhold Social Security and Medicare taxes from their paychecks. Employees pay 6.2% for Social Security up to a cap. Once their combined income from wages, tips, and self-employment income exceeds this cap of $160,000 roundabouts for 2023, this cap varies by year, it keeps going up and up and up. After they hit the cap, there's no more Social Security tax to pay. It's called the maximum taxable earnings. They also pay 1.45% on their income without a cap for Medicare. You typically withhold these from the employee's paychecks and you remit them to the IRS. We'll talk about how and when you do that in a little bit later. And then you have what's called the employer match. Basically, you're withholding 6.2% for Social Security, 1.45% for Medicare. You as the employer need to pay that 7.65% yourself on top of what you withhold. So you're withholding 7.65% from the employees, and you're paying an extra 7.65% yourself as the employer for a combined rate of 15.3% on their salary. That's Social Security and Medicare tax. A lot of folks bring up the additional Medicare tax. It rarely applies, but for those high earners, it's worth knowing it's an additional 0.9% Medicare tax on wages above $200,000. As with all progressive taxes, it's not if you hit $200,000, you have to pay that on everything you made. It's just everything above $200,000. Which I'll give you some examples in a minute here, but there's no employer match for the additional Medicare tax. Also, the employer match for Social Security, it drops off when the employee's Social Security drops off. So if they hit the $160,200 and no longer have Social Security, that drops off for you as well, typically. So let's look at the FICA taxes. Federal Insurance Contributions Act. The employee, so let's look at an example of how this works. The employees paid $300,000 in calendar year 2023. The employee has to pay a 6.2% Social Security tax. So we covered that on the first 160,200 of income. So that's almost 10 grand there. They have to pay the Medicare tax on all of their income. Then they have to pay the 0.9% additional Medicare tax on the last 100,000 of income. So you figure out the employee's tax burden, and then the employer has to match everything but the additional Medicare tax. And so that's the employer burden. This is how these calculations work. And if I'm spooking anyone here, I've got a good recommendation for you that I'll bring up again later. Don't sweat this stuff. Don't think you have to personally be breaking out your calculator and doing this math. This is all something that if you have a payroll provider, whether it's a local option or a national outfit, they do this for you. It's their job to compute withholdings, both for the employee and the employer. They typically tell you what the employer's share is, so you set that aside, or they withdraw it from your account when they make payroll. And in a lot of cases, these payroll providers are going to make these payments to the IRS and to the state on your behalf. So if this seems spooky, it really shouldn't be, because a lot of this gets handled on the back end without you being involved. It's just important for you to know it so that you know what's happening. Because, and we'll talk about this with self-employment, the self-employment, Social Security and Medicare tax. Some of that is stuff that, especially if you don't have a payroll provider because you're not a W-2 employee, you will have to do, or you'll have to have your accountant or CPA do. Again, there are people who do this for you. You just need to make sure that you're hiring them and making good use of them. But for self-employed people, people who aren't W-2 employees, people who aren't being paid a salary from their company, which we'll talk about S Corp in a second here, but for everyone, like if you own a sole proprietorship, an LLC taxed as a disregarded entity, a partnership, an LLC taxed as a partnership, you can't be a W-2 employee. Everything you have is considered self-employment income, and so it's all subject to income tax and self-employment tax, which is again Social Security and Medicare. So you have to pay it. The self-employment tax is basically the employees and employers' half of Social Security and Medicare. Because you are your own employer, essentially, you're paying both halves of this to the government. And so it's 12.4% for Social Security, 2.9% for Medicare. The same cap applies after you've paid taxes on 160,200 of taxable income. The Social Security tax drops off. You still have the 0.9% additional Medicare tax that'll apply for income above 200 grand. And so just think of it as like a doubling up. You're paying both the employees and employers halves of Social Security and Medicare tax on your self-employment income. There's a very commonly misunderstood thing called it's called the self-employment tax multiplier. You see I'm using 92.35% here. This was an attempt by the IRS to kind of balance out that disparity, because employees only have to pay tax on 7.65% of their income. Self-employed people have to pay tax on over 15%. So what they do is they reduce the amount of your self-employment income you have to pay the tax on by 7.65%. So the math gets a little weird, which I'm about to demonstrate. I cannot recommend enough having a good accountant or CPA or comptroller, if your company's large enough to have an internal comptroller, someone with the skill set and the training to do all of this for you, to set it aside, to pay it to the IRS. It's worth knowing this stuff as a business owner, but it's usually not worth trying to do it yourself, because that's where the little mistakes come in, and the little mistakes are what snowball into big issues that the IRS and Tax and Rev make a fuss about. So let's look at some math here. A self-employed person, same figures. They own an LLC. Let's say it's single owner, taxed as a disregarded entity. They have net business income of 300 grand, which, you know, you've netted out all the deductible expenses. That's what they have to pay taxes on. So you figure out for Social Security, it's going to be the lesser of this figure here, which is just the rate times the income of 34, because that's like 34 grand, or you do the Social Security rate up to the cap of $160,200, which it caps out in this case at about $19,864. So once you hit that cap, that's what you're paying in Social Security taxes. You've got Medicare taxes, kind of similar thing. You use the multiplier, you multiply by the Medicare tax rate, and then you've got the additional Medicare tax and everything above 200 grand for this self-employment tax computation. Keep in mind these numbers. I'm giving you some math examples. I'm not guaranteeing their accuracy because I'm a tax attorney, not an accountant. I don't do tax preparation. Most tax attorneys don't or shouldn't. This is really just more to illustrate how the process would work normally. But again, this is where you leverage your resources appropriately with a good payroll provider or accountant or CPA who can do this math for you. There's online services, even for self-employed people, that can do this math for you if you don't want to take the step of hiring a CPA or someone. So just find a good resource that works for you. Payroll taxes. Payroll taxes are essentially what you do with all that money that you just withheld and set aside. When you withhold money from your employees' paychecks, you're typically withholding federal and state income taxes, Social Security, and Medicare taxes. Those taxes have to be paid to the IRS and to the state of New Mexico in the case of state income taxes. Again, for paycheck withholdings, this is all normally done by your payroll provider. And I'm going to give you an example, even though I cannot and will not endorse any specific service provider, third party or otherwise. I'm not recommending anyone. This is just for purposes of illustration. But ADP, when we used ADP, they would pull this money from employees' paychecks. They would set it aside in ADP's own trust account, and they would pay it to the IRS and to the state on a, I think, semi-weekly basis. It varies between semi-weekly and monthly, depending on your situation, but they would pay it automatically. And so we wouldn't have to deal with that aspect. It never really touched our bank account once it counted as an employee withholding. So there's never any temptation to spend it, which we will cover in a second here. But a lot of it was handled for us. And that's just nice. I mean, especially as a business owner, you don't want to be holding on to that money or having to deal with how do I pay it to the IRS and to the state and when. But just so you understand how this all works on the back end, there's certain forms that have to be used to report and pay this. 941 is what's typically used by business owners. It should be filed quarterly, and it's what you use to report all of the income and taxes that were, all the taxes that are withheld from paychecks within the quarter. You file it quarterly, but again, you have to make those deposits with the IRS more often than quarterly. It's typically semi-weekly or monthly. You make those deposits with the IRS, and then you report on the Form 941 all the deposits that you made. This form is worth knowing because those payroll providers will typically make the deposits for you, but they won't always do the 941 for you. So it's worth knowing, will they or won't they? Because if they won't, it's something you either have to do yourself or you have to have your accountant or CPA do it. If the 941 doesn't get filed, the IRS gets very, 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 very particular, very angry. We'll talk about why in a second here. 944, it's an alternative to 941 for the smallest employers. To be honest, I've never seen it used, but I have a lot of business owners ask me, can I use it? And the answer is usually no, because you can only use it if the combined annual liability for Social Security, Medicare, and federal income taxes is $1,000 or less. That's very rare in the year of our Lord 2023. That $1,000 figure was set, I think, decades ago. It just hasn't kept up with advances in, payroll and wages. So expect to use the 941. I cannot stress enough that you should take these taxes seriously. The IRS considers taxes withheld from employees' pay to be trust fund taxes. Trust fund taxes being money that belongs to the government that you, the employer, are holding in trust until it's time to remit it. It's money that does not belong to you. You're holding it for the benefit of the government until the government has paid it, but it's the government's money from the moment it gets withheld from the employee's paychecks. It's also, in a sense, the employee's money, because what you're doing is you're withholding money that the employee is obligated to pay to the IRS. You're acting as a steward or an intermediary of those funds, but it harms not only government, but the employee. If you take that money out of their paychecks and fail to remit it, a common example of how is, the employee, it's their obligation to pay Social Security so that when it comes time to retire, they can collect on it. If you fail to remit the Social Security payments, I mean, the IRS isn't going to go after the employee. Generally, they're going to go after you as the employer, but it theoretically harms them because they're not honoring their obligation. So the IRS takes this extremely seriously. I want to say 4 out of 5 tax controversies that go to serious collections that then come across my desk are payroll tax delinquencies. And unfortunately for those clients, there's not a lot I can do for them. I basically go to the IRS and I try and smooth things over and say, they didn't know what they were doing. It's an honest mistake. Can't we work out a payment arrangement? Can't we get them on an installment plan? Because you can't discharge payroll taxes in bankruptcy. The company can't shed them. The company cannot, get rid of them, negotiate them down with an offer in compromise. Payroll taxes will haunt the business and the business owners typically until they're paid. The IRS has in it's called the Internal Revenue Manual. It's their policies and procedures guide for how they do what they do. They have protocols for how they collect payroll taxes. And the rule is basically go scorched earth, turn over every stone. And if you don't think the business and the business owners can pay the tax, start levying their bank accounts down to zero. Get as much as you possibly can from them, as often as you can, bleed them dry and get as much of this tax as you can. I kid you not, it's very draconian. So if you, and I get this question a lot, I've got other debts, I've got to pay rent, I've got to do this, that, and the other thing, and I've got these payroll tax withholdings. Can I use them for that and then pay the IRS later? And my answer to them is, I would strongly recommend against doing that. If there's one debt, one obligation that you should pay above all others, it's your payroll tax obligations. Because again, those other debts, you can discharge them in bankruptcy, you can negotiate them down, you can stall in court for years. The other creditors can't levy your bank accounts into the ground the way the IRS can. So pay your payroll taxes. The other reason to pay them is that the IRS will assess a penalty against anyone involved in the business who is responsible for collecting, accounting for, and paying those trust fund taxes and who willfully fails to do it. And just for the record, using that money to pay other creditors is evidence of willful decision not to pay the payroll taxes. So they will assess a trust fund recovery penalty equal to the amount of the unpaid payroll taxes. So not only do you have to pay those payroll taxes, you also got to reckon with the trust fund recovery penalty. It's typically not dischargeable in bankruptcy with a few very limited exceptions. And so these are the sorts of things that will haunt you as the business owner until they're paid off or you pass on. It's nuts. So if I'm spooking you on this, good, because these are the one of all the taxes, these are the taxes you don't want to run afoul of. Let me see here really quick. So that's payroll taxes in a nutshell. Now we're going to spend some time talking about New Mexico's gross receipts tax. This is our alternative to the sales tax. Most states have a sales tax, which is a tax on the buyer of goods. Think you go to New York, for example, you go to a store, you buy something, you see that 9% tax or whatever it is in New York, that's added to your tab, to your check that you pay. It's billed as a sales tax. The seller collects the sales tax from you, the buyer, and holds it in trust for the state, similar to payroll taxes, but a little bit less terrifying. The process around unpaid sales taxes usually isn't quite so horrifying as payroll taxes. And then the sales tax gets paid to the state on the buyer's behalf on a monthly or quarterly basis. We have a gross receipts tax, which looks a lot like a sales tax. In fact, if you buy goods from some stores, their systems aren't capable of spelling out the words gross receipts tax on the receipt. And so it'll say something like sales tax or surcharge. And it's, typically if you're in Albuquerque, it's 7.75%. And it's collected and paid much the same way, but it is fundamentally a very different tax. Because whereas the sales tax is a tax on the buyer of goods, the gross receipts tax is a tax on the seller of goods or provider of services. And that last bit is key, because we don't just tax the sale of physical goods here. We tax services that get provided. And there is a very important policy reason why the state of New Mexico has a gross receipts tax instead of a sales tax. I will tell you from the outset, I personally do not like the gross receipts tax. It is in many ways a very business unfriendly tax because it is very difficult for most business owners to wrap their heads around. And it is a tax that makes it very difficult for a lot of businesses to do business in the state. But there's a reason we have it. Our economy is heavily reliant on federal spending and federal contracts, whether that's national lab contracts or federal investment, construction services, you name it. We have a lot of federal dollars coming into the state. But the federal government cannot be made to pay a sales tax. And so because of how lopsided our economy is in the sense that it's very reliant on federal dollars, and because of the fact that most states are heavily funded by a sales tax. In our case, we needed something that would function like a sales tax, but that would let us get some of the revenue from those federal contracts into the government tax coffers. And the solution is the gross receipts tax, because while we cannot tax the federal government as the buyer of services that New Mexico service providers give, like the construction companies and so on, we can tax the construction companies on the revenue they're making. And so we impose a tax. It's like 5.25% plus local options, which we'll cover in a second here. It is a tax that is imposed on the seller of goods or provider of services, even if the service provider can't pass that on to the buyer, i.e. the federal government. There's a lot of exemptions or deductions that apply to this tax that reduce the tax obligation in some cases that we'll cover. But that's the gist of it, is that it is a tax on the seller of goods or provider of services. That has a lot of knock-on effects. The downsides to this approach are obvious because you can't design a tax specifically for contracts with the federal government. There are constitutional reasons why that tax would not work. And so to make a tax like this, you have to apply it evenly across the board, subject to exemptions and deductions, which means that virtually every independent contractor in this state, if you have 1099 income, there's a good chance you fall under the ambit of the gross receipts tax. This includes, without limitation, students who work summer jobs not as W-2 employees. If they're 1099, they fall under the gross receipts tax. College interns working as 1099 contractors. plumbers, electricians, doctors, lawyers, and so on. I have a little exclamation point beside doctors because the gross receipts tax is one of two reasons very commonly cited for why we have a doctor shortage in the state. Because we are, I think, the only state that imposes a sales tax or equivalent on medical services provided by doctors. There are some exceptions for services provided by hospitals, but by and large, like if you go to an outpatient clinic, there's a good chance you're going to be subject to the gross receipts tax. And by you, I mean the doctor, because while we tax the doctor as the service provider, that tax cannot be passed on to the patient in most cases. So the doctors have to absorb that roundabout 8% gross receipts tax. It's just something that they have to pay, even if they can't pass it on. And so that's one of the reasons why we arguably have a doctor shortage in the state. I see this a lot. And the state, believe it or not, the state has been known to somewhat aggressively pursue this tax against everyone falling under its ambit, including, I saw this with some of my law school classmates pretty hilariously, summer interns who are 1099. If you have 1099 income, it typically gets reported on your Schedule C, unless, again, you have like a partnership or an S Corp or something. And so the state gets a copy of your Schedule C, they see the business income. If you didn't file a gross receipts tax return and pay gross receipts tax on that income, after a couple of years, they'll come out and say, hey, we think that you owe gross receipts tax on this. The statute of limitations is about 7 years on gross receipts tax. And so they will come out and they will try and collect that tax. And so just understand that no matter where you fall in the taxability spectrum here, it's something that you do have to deal with, especially as a business owner. How does it work? It is a tax, this is the language from the statute. It's a tax for the privilege of engaging in business in New Mexico, an excise tax equal to 5 1/8% plus local add-ons, which we'll talk about in a second, on gross receipts. Gross receipts has a definition. It's the total amount of money or the value of other consideration received from selling property in New Mexico, from leasing or licensing property employed in New Mexico, from granting a right to use a franchise in New Mexico, from selling services performed outside New Mexico, the product of which is initially used in New Mexico, or for performing services in New Mexico. You typically see this apply to selling property in New Mexico or performing services in New Mexico. That's the vast majority of gross receipts taxes from those two activities. It's pretty rare that you get people providing services outside of New Mexico, the product of which is initially used in New Mexico. It happens from time to time. And if there's sufficient tax nexus, that out-of-state business will have to pay gross receipts tax. But by and large, it's from selling goods or providing services in New Mexico. Engaging in business is an extremely broad concept. It's carrying on any activity with the purpose of direct or indirect benefit. That doesn't even mean profit. That means direct or indirect benefit. So if you're asking, am I doing business in New Mexico under the Gross Receipts Tax Act? The answer is probably yes. This last tidbit's a little interesting. This follows the US or South Dakota versus Wayfair Supreme Court decision a couple of years ago, where the Supreme Court said you can collect sales tax from out-of-state sellers now. The rule here is if you're selling at least $100,000 into the state, you can become subject to our gross receipts tax, even if you're not based in our state. So think Amazon and so on. They're subject to our gross receipts tax now because of the collective sales volume of at least $100,000. That's why when you buy stuff from online retailers now, you see the gross receipts tax added, even if that retailer is based somewhere else. So the first question I get a lot, can I pass this tax on to my customers or clients? And the answer is absolutely. Unless they're the federal government, because then they're going to refuse to pay. You are allowed to pass the tax on to the buyer of your goods or services, and that includes nonprofits. because, and this is a bit of a thing to wrap your head around. Nonprofits, 501c3 nonprofits in other states, they're typically exempt from paying sales tax. If they give the nonprofit certificate to the seller of goods, that seller of goods will take off the sales tax from their purchase. It doesn't work that way in New Mexico because it's not a tax imposed on the buyer, being a nonprofit, it's a tax imposed on the seller, which is you. And so if the nonprofit is the buyer, the gross receipts tax still applies unless there's a limited deduction for sales to nonprofits for, I think, services that are used within their nonprofit scope. It's a limited deduction, but if in that case, they have to issue a non-taxable transaction certificate to you that would release you from your obligation to pay gross receipts taxes. It's a whole thing. So as a general rule, if you have a buyer who's refusing to pay the tax, they either need to provide you with legal justification for why and for getting you out of the tax, which is a non-taxable transaction certificate or other evidence satisfactory to the state that your tax obligation is, it doesn't apply. Or if they just say, no, I just don't want to pay the tax, you have to decide whether you want to personally absorb the tax or turn them away, because it's a tax on you, not on them, even if you don't pass it on. That's really important to understand, is that it's a tax on you, the seller. Are there ways to reduce or eliminate my gross receipts tax liability? Yes, to a limited extent. We have a number of exemptions and deductions, and it's important to understand the difference between them, because exemptions are categories of income spelled out in the Gross Receipts Tax Act that are not considered gross receipts and don't need to be reported in the gross receipts tax returns. When you do the gross receipts tax returns, what you're really reporting to Tax and Rev is the amount of gross receipts, not gross income, but the amount of gross receipts. You then have deductions, which are categories of income that do need to be reported. It's still considered gross receipts, but it's not subject to the tax. You take the deduction, you net it out, and then you pay tax on everything that's remaining. So when you have a gross receipts tax return, you report the gross receipts, which is like your revenue less exemptions. You report the deductions that you're taking out of gross receipts, and then you have the difference, and that's what you pay tax on. So exemptions are amounts that you don't report, deductions are amounts that you do report, but that you don't have to pay tax on. Some common deductions, very common deductions, and this first one is the most common one I get asked about: the sales to out-of-state buyers. If you are a New Mexico-based seller or service provider, and you're selling services that are being purchased by out-of-state businesses, as long as those services are being received and initially used outside the state of New Mexico, those services are typically deductible under 7-9-57, which it's important that you have these numbers, because now when you do your gross receipts tax returns and you take a deduction, you have to point to the statute that allows the deduction. There's a drop-down menu and you have to select the one that you want to use. So out-of-state buyers, 7-9-57. It is extremely important to remember that with deductions, you have to report the income. You have to do the gross receipts tax returns. You claim the deduction, and then you pay tax on the difference. If that difference, if the remainder is $0, you pay $0 in taxes, but you still have to do the reports. If you don't do the tax returns, the state will assume that your income is not deductible, and they will do an audit and make an assessment, and then you have to prove to them, no, it's actually deductible, and you still have to pay non-filer penalties. So do the returns, even if all of your income is from sales to out-of-state buyers. A very common example of this is people who have clients they provide consultations to over Zoom. If you're doing consult or counseling or whatnot over Zoom to people from out of state, the money from those out-of-state buyers is typically deductible under this section. Another common one is sales of a product or service for resale. This deduction is meant to avoid what's called tax pyramiding, which is making this equivalent to like a value-added tax in Europe. It's to avoid taxing the supply chain over and over again. If I am a wholesaler and I'm selling products to a retailer for sale to customers, the retailer is reselling the products I'm selling to them. And so the state only wants to collect gross receipts tax on that once at the point of sale when the retailer sells to customers. And so what happens is, let's say I'm selling to a reseller. They don't want to pay me gross receipts tax on that because they have to charge and pay gross receipts. Well, they have to pay gross receipts tax on their sale to the ultimate buyer. So what they do is they give to me, the wholesaler, a non-taxable transaction certificate that you get from Tax and Rev saying, I am a reseller of your goods. They give me, the wholesaler, that NTTC saying they're going to resell my goods. And then I don't have to pay the gross receipts tax on my sale of goods to that reseller, to that retailer. And so I can take that off of what I'm charging them. And then I turn around when I do my gross receipts tax return to the state and say, this revenue is not subject to gross receipts tax. I'm taking this deduction because I sold this much to a reseller. And that's how that process works. Again, it's a situation where you do have to report the income and you take the deduction. Another common one is the sale of construction materials or services to persons engaged in the construction business. Think subcontractors, think Home Depot or Lowe's. Generally, I mean, there's different situations where this applies, but if you're in construction, it's important to know these deductions so that you're not stacking gross receipts tax, whether or not you intend to pass that cost on to the customer or otherwise. There's just no need to stack gross receipts tax. The state only wants that money once. Selling or leasing real property. If you're leasing a home, typically that's not subject to gross receipts tax. If you're selling your home, that's typically not subject to gross receipts tax. For this, and more generally, because that's not gross receipts, because you're not engaged in the business of selling your home. But if you are engaged in the business of selling homes, that's probably not subject to gross receipts tax because of this deduction. And so that's another one that applies. Leasing real property. I get that question a lot. I'm leasing out my home. Do I need to charge gross receipts tax? The answer is no, but this deduction generally applies. The gross receipts tax, one big criticism of it, the Tax Act is littered with exemptions for pet industries of the legislature. And I don't mean to be mean or trite here, but horse racing gets its very special treatment under the Gross Receipts Tax Act. Stuff like that. The oil and gas industry has a lot of specific carve-outs, which I'm not knocking the oil and gas industry, believe me, but the Tax Act is complicated because it's a tax that's imposed on everyone, and then it's got all of those deductions and exemptions. So I'll wrap this up here and get to the Q&A. How often do I have to report and pay it? It depends, typically monthly. You might be able to do a quarterly or semi-annually, depending on how much your gross receipts top tax obligation really is each month. If your obligation averages $1,000 or more, you have to be monthly. Tax and Rev will assume you're going to be monthly unless you ask them to be otherwise. Most clients of mine just end up filing monthly anyway to do it, but some of them are quarterly. How and where do you report it? There's an online taxpayer access point. Just get your business tax ID number if you don't already have it, register for your online tax account, and then you can file your returns and make payments through that, or have your accountant or CPA do it. I kid you not, CPAs are a blessing when it comes to these sorts of taxes. If you are going to use a CPA, I recommend one based in New Mexico, because out-of-state CPAs just aren't familiar with the gross receipts tax, and they can, will, and very often do mess it up. So for this tax, use a New Mexico-based accountant or CPA. If There's a few other taxes that aren't worth a lot of consideration here. Franchise taxes, they're a tax for the privilege of existing and doing business. It's $50 a year on corporations and LLCs taxed as corporations. Unemployment taxes, you pay those to the state and to the federal government. It's like a combined 6% for federal minus any taxes paid to the state. New Mexico has variable rate unemployment taxes, which are based on a number of employment related factors. Compensating tax is a form of use tax for property by outside New Mexico that is used in New Mexico. Compensating tax is pretty weird and it's littered with exceptions or deductions. So if you're worried about that, definitely ask your accountant or CPA. And property taxes, if you're a business that owns property, you're going to be paying property taxes on that property to the local. It's typically a locality tax. It's the biggest funding mechanism for local governments and public schools, apart from, in this case, the local gross receipts tax. So let's start taking some of these questions. With regard to CRS taxes, I'm going to take the first one. With regard to CRS taxes, if you make $10,000 for the year and you pay the CRS quarterly, does that translate onto your personal income tax forms for payment on state taxes, or is it doubling up? Good question. So you typically deduct the amount that you pay in gross receipts taxes from your income taxes. And the reason for that is if you're collecting 7.5% on top of your what you're charging your customer for gross receipts tax, that gets factored into your income. And so you deduct that back out, so you're not paying income tax on money that you pay to the state for gross receipts taxes. And so the very short answer is that gets deducted out of your income tax. You're not paying income tax on money you pay to the state for gross receipts tax. If you're behind on filing 941s or paying payroll taxes, how do you reconcile and get on track? Talk to a CPA and have them go through the actual tax liability and prepare and file the returns and get those returns submitted along with the payments that you need to make. And you want to do that before the IRS comes after you, because if they come after you, that's when the trust fund recovery penalty is going to start coming up. You want to get that paid before questions of the trust fund recovery penalty start coming up, because once that penalty is assessed, it's there. So get straight with that sooner rather than later. Is it better to pay yourself through the W-2 or the owner's draw? You've been doing a W-2 for yourself and your employee, LLC single owner with one employee and yourself. I'm going to assume that your LLC is taxed as an S Corp, because if it's not, you cannot be a W-2 employee of your own LLC. It's only when it's taxed as an S Corp that you are able to be a W-2 employee of it. The S Corp taxation requires that you pay yourself a reasonable W-2 salary, reasonable in the eyes of the IRS. If you make it too low, they'll penalize you. And the reason for that is you pay Social Security and Medicare taxes out of your W-2 income as the owner of an S Corp. But you don't pay those taxes, Social Security and Medicare, on the profits above and beyond your salary, the net business income, if you have an S Corp. And so the answer to your question is both. You have to pay yourself the reasonable salary, but then what you want is net business income above and beyond that salary, because that's where the tax savings is. You're not paying Social Security and Medicare tax on that net business income above and beyond your salary with an S Corp type entity. So the answer to your question is basically you have to do both. You want to do both. Does a consulting service provider pay gross receipts taxes on services provided to out-of-state clients? Again, if you're providing those services from New Mexico remotely to out-of-state clients, they're not based in New Mexico, they're not receiving the services in New Mexico, you're just consulting with them. The answer is typically no, it's deductible under 7957. You still have to report the income and take the deduction. I'm a graphic designer with an LLC. Do I include a gross receipts tax as a separate line item with your invoices, or do you account for that in pricing for your services? Separate line item. You should separately state the gross receipts tax. In fact, as of a couple of years ago, that is the rule. If you don't do that, you cannot, it's a weird consequence, but basically you're going to be paying some tax on the amount that is already being subject to gross receipts tax. You don't get to deduct that out. So you need to separately state the gross receipts tax you're passing on to a customer. Otherwise, you're paying gross receipts tax on that amount too. It's weird. You're an artist that sells through a gallery. So who is paying the gross receipts tax? That's a good conversation to have with the gallery. Typically, if the gallery is selling on consignment, the answer is you. Although there are some deductions or exceptions for consignment. If you're selling to the gallery and the gallery is selling to a customer, it's a resale situation. You want to make sure you're getting that reseller thing sorted. If you're paying gross receipts tax monthly in 2022, the majority of your income was from services provided to out-of-state clients. You never put a deduction in. Yes, you should absolutely amend your 2022 returns. Go ahead and report the income and state the deduction, even if the tax obligations is exactly the same. That way, Tax and Rev knows that the income has been accounted for. And so they're not going to come asking why you didn't report it or pay tax on it. You have an LLC owned by a husband, the wife is an employee. Can it be taxed as a disregarded entity? Yes, and this is a fun feature of New Mexico being a community property state. Technically, the LLC is owned by both of you if you started it after you got married. It's considered community property that's owned 100% by both of you jointly. And so in a community property state like ours, it can still be taxed as a disregarded entity, even though it has two owners, because for tax purposes, the two of you are one marital community. And so, yes, it can be. But as a consequence of that, your wife cannot be a W-2 employee of an LLC that is owned by the marital community. So you're probably doing that wrong, and your wife would need to be paid just as you are through owner draws or distributions. Again, disregarded entities, the owners cannot be W-2 employees of them. And since your wife is a joint owners, part of the marital community, no W-2 income there. It should all be treated as owner draws or distributions, subject to the self-employment taxes. As a subcontractor, do I need to file taxes annually or quarterly? There's not a simple answer to that, because you need to do your gross receipts tax returns quarterly, if not monthly. And you need to do your annual income tax returns, but you need to pay quarterly estimated taxes on the income that you think you're going to make. So the answer is all of the above. Can you explain the mechanics of New Mexico state payroll taxes? Not in the amount of time we have. The very short answer is you get a business tax ID number with the state of New Mexico. That business tax ID number is used by both you and your payroll provider to remit the various withholdings on behalf of your business and its employees. And so you're going to file certain returns yourself in your taxpayer access point, like the gross receipts tax returns, corporate income tax returns if you are C Corp, compensating and use tax returns, things like that. But the payroll provider is going to file and pay, deposits for payroll taxes and so on under your business tax ID number, all the same, and that all gets reconciled out. Correction to the last question, LLC is owned by the husband, wife is an employee. Can it be taxed as a single member LLC? Again, yes, it can. It can be taxed as a single member disregarded entity, but the wife is considered an owner under community property law. The only way to avoid that is for the wife to literally, under contract, disclaim any community property interest in the LLC. Unless the LLC was started before you all got married, in which case it's not community property. It's a thing. Community property complicates taxes for LLCs and corporations owned by a husband and wife or by two spouses. And so if you wanted to have the wife as a W-2 employee, she would need to not be a co-owner, which means it would need to not be community property, which means you would need to execute a document having her disclaim any community property interest, which I usually recommend having a lawyer prepare, because the IRS and the state, they do not like that process. They barely recognize community property disclaimers. I'm glad to have helped. Thank you, everyone, so much. I've got a few last questions here. You're an oil field retail parts selling outside of New Mexico. You are going to want to consult with a good CPA or a tax attorney. Like I said, the Gross Receipts Tax Act is littered with exemptions and deductions for the oil and gas industry. So we would need to drill down what specifically you're doing and who you're selling to. And we would figure out what exemptions or deductions apply. And then from there, go about how you go about reporting that. How do you exclude those sales from your total for the month? Again, it depends really on what's applying there. If your agency pays your gross receipts tax as a subcontractor, will you still need to pay quarterly or other taxes? It depends. If you're selling your services to your agency for resale, again, that's a resale situation. If they give you a reseller certificate, you would still report the income, but you would apply the deduction as a reseller because your services are being sold to the agency for resale. If you're a W-2 employee of the agency, the gross receipts tax doesn't apply. The gross receipts tax does not apply on your W-2 income. And so if you're a W-2 employee of the agency, the gross receipts tax doesn't factor in. Your agency will have to charge gross receipts tax, but it's not your problem. You have an LLC, sole proprietorship. Your husband isn't involved in the LLC. He still has ownership. Welcome to New Mexico. Welcome to any of the 9 community property states in this country. If you start the LLC after you get married, it is considered marital community property. It is because you, at that point, cease to be an individual taxpayer. You are a marital community. And so under the eyes of the law, as a property owner, like a marital community property owner, yes, the LLC is owned by you both jointly. It's not you 50%, him 50%. It is you and him jointly own 100% of it, which is another hard thing to wrap your head around. It took me a long time to get used to that, but that is the gist of it, is yes, unless he disclaims his interest. Thank you everyone for attending today. If you have other questions, please feel free to reach out. Again, to me or to some other competent attorney. I'm not here to sell you on my services, but I am happy to work with you. Please feel free to reach out. Or again, the SBDC is a fantastic resource that is often no cost to you. So make good use of your resources. Thank you.
Thank you so much, Ian. It was a great presentation. Thank you everyone for those questions. And of course, it's being recorded. I will share the record. It will be on our MBDA YouTube channel. And Ian, when you're done, you can share with me the presentation and I will share with all the attendees. And thank you.
Thank you.
Have a great day.
You too.